Joining us this morning on Studio 10 is financial expert Dale Gillham. Hi, Dale.
Hello. Finance expert Dale Gillham from Wealth Within. It's nice to see you again.
It's amazing listening to a professional trader who's doing what you're aspiring to do and hearing it firsthand.
Too many people ring me up and say, hey Dale, I want to make quick money, but it's not about getting rich quick. I think we can go for about 4 hours, but I'm not sure my wife would like that. So
I'd say congratulations for putting your time and effort out there, because you probably don't really have to do it. You're successful traders in your own right.
Thank you very much for opening up my mind with trading.
So of course you can succeed, of course you can, and you're the only one holding yourself back or succeeding, and that feels very empowering actually.
A quick reminder before the show starts that this live stream is an educational tool, and as such your personal circumstances have not been considered. We hope you enjoyed this week's show.
Good evening and welcome to the Australian Stock Market Show. Tonight, as always, our aim is to shed some light on what is happening in the Australian stock market, as our goal is to inform and educate you on the realities of successful investing and trading. This is also the show where you get to ask us, the stock market experts, your questions and we give you the answers. Our topic for tonight, Australian superannuation, is this the best way to save for retirement? Hello, I'm Janine Cox and joining me tonight is Dale Gillham, and we're Australia's most trusted stock market educators.
Hey Janine, hey, how you doing?
Yeah, good, and yourself?
Oh, I'm fed up of this whole COVID lockdown shutdown stuff.
Can I find him? Actually, he's already he owes one for the swear jar already before the show.
When did I do that?
You swore before the show. I picked you up. You better.
You're like my wife.
Better fork up. Come up with the goods, please.
With the, I don't know, whatever it is, but the whole lockdown
this is
stuff.
This is Dale's swear jar. It's not Janine's swear jar.
I know, I've got one for you anyway.
But I'm controlling it.
I don't know. Everything I'm trying to do in lockdown, you're not allowed to do. It's like, I haven't been out of the front gate, other than to collect my bins off the front.
Yeah.
In 5 days. Wow. And it's like, what do you do?
The neighbours won't know you anymore.
I don't even know me anymore. It's like I go to the mirror and go, who's that dude? It's a bit funny, but oh well.
It's been interesting on the markets, hasn't it?
Surprising. I mean, the US market went up. That surprised me.
Well, as soon as they started talking about the continuation of the funding over in the US, that just pushed the markets higher, but it's on hot air, isn't it?
Well, yeah, I mean, they are pushing them, and they're continually pushing the market up, but all the experts that I'm seeing or listening to or talking with on the US market, they're all saying it's getting dangerous, and I'm saying the same sort of thing. I thought the market, or the US market, had its short-term high. I'm about to start to go into its low, but it looks like it may not have had it yet.
But isn't it always the way that if people talk it down, eventually that term will happen, but it could take time, and so it could continue to go up.
Yeah, but at least things are happening in the US. I mean, Trump's put a couple of executive orders out, and he's giving, keeping the unemployment benefits going, even though he's reduced it. I was talking about that with Jim on my US market report today, and I was also talking a little bit about some of the other things that are going on with China, like with WeChat and what's the other one? The TikTok.
Yes, TikTok.
Stupid things. I don't know. TikTok. What a name for a business, TikTok.
Well, look, it's making a lot of money. It's doing well, apparently, so are you going to criticise it?
Okay. Well, anyway, remember, if you have a burning question for us, record a 30-second video and email it to info@wealthwithin.com.au. But if you are shy, you can also send us your questions as an email. Don't post questions below. Please don't do that. We're not going to look at them. Unless they're an email, we're not going to look at them, or a video, we're not going to look at them. So I know some people have posted a couple of questions on the actual YouTube channel. Emails only. But if tonight is your first time watching, then thanks for joining us and welcome to the show. We're looking forward to hopefully educating and informing you.
Moving on, it is the second Tuesday in the month, and this means, thank you.
Okay, drum rolls.
We look at sectors and indices in the ordinary.
I'm going to get my drumsticks out. I've got some drumsticks. I'm going to get them out.
Okay.
I do. Not chicken ones either.
I've been wanting you to get the guitar out for a while.
Chicken drumsticks. Chicken, no.
So let's get into the charts right now.
Goes with my vegan chicken.
Okay. Here we have the list of all of the sectors on the Australian market. There you can see
So that's
the
for
S&P
August, so
ASX 200 and the different sectors. So yeah, this is for the month so far.
Energy and materials. Energy has been really hit hard most of this year. And look at that.
Oh,
It's
for
really
years it's actually been hit hard, really, which is interesting. And with the oil price being so volatile, of course, it's copped the brunt of that. But 6.2% up for the month is a good result. And materials up about 5.6.
and Infotech down at 1.56. So
Yeah, so that's telling you a lot. But then it's a bit of a change of the guards because energy was down, information technology was up. It's switch, isn't it? Really?
yeah, and healthcare is still it's in that bottom third, isn't it?
Yeah,
So financials is a little bit better in the mid range there, at 2.8. But what's been going on for the year though? That's the interesting thing because people often ask, what's the next best performing sector? Because that's what I was talking about with Jim on my market report for the US, is saying it's not what's been hot, it's what's going to be hot next that you need to look at for the opportunity. So, and what we need to know is obviously what's gone up will come down and what's gone down will come up. So where are we looking at now?
Well, I guess you could take it in reverse and you could look at what's been hot and then ignore those, and then it reduces your list, doesn't it?
Well, it can be.
Okay, so information technology
Still leading
up
the back.
18.66 for the year, so still strong. So you'd expect it to come off the boil, wouldn't you? Consumer staples also up, so I'd expect that to come off the boil in the coming weeks. And materials up 7.5%. We've got financials down 18.4%, industrials down 18%, and energy down 35%. So these are the ones, the last three are the ones that I'm looking to see a bit of a turnaround in, particularly industrials and energy. So, if we see that unfold, then that could signal something really important for the market.
Yeah, I know Ampol has done well the last few weeks. It's done reasonably well there. I know there's a few other things like Oil Search has done a lot better in the last few weeks. Companies like that. Looking at looking at materials, you've had Fortescue making new all-time highs, but BHP and Rio are lagging behind all that. I know a lot of people have been jumping on Fortescue.
Yeah, well, there's some things obviously adverse in the media about Rio at the moment, and so that's been pushing the share price down. But, if you're looking at what's going on across those individual stocks, particularly in the top end of the market, it was interesting at the start of the week yesterday to see that the ASX 20 was actually up more strongly than the ASX 200. So I thought, well, okay, it's a flight to defensive.
Well, that's what I was saying on seriously, that's what I was saying on my US report today. It's because the Dow was one of the strongest index in the world last week. And out of the Dow, the NASDAQ and the S&P in the US, the NASDAQ was third. Where the last few months it's been first because it's been doing really, really well. The Dow's still down for the calendar year, about 3%, where the NASDAQ's still way up. It's past its all-time high, so it's done really, really well. But the same thing, is that a flight from tech into high-quality, good defensive stocks? Because if it's happening in the US and it's happening here, we might be starting to see that now.
Yeah, well, we're expecting the primary peak to come in, or the cycle peak to come in for some of these bigger stocks.
Yeah.
And it should be in any time now. So maybe that's a sign that it's actually coming due.
Well, that's
in
what
the
I was
next couple
saying.
of weeks.
I thought we'd already had it. I really did think we'd had it up until last week's close. So it'd be interesting to see where we finish up this week.
Will do. The market hasn't pulled back though.
All right, well, let's get down into your questions. So now's the time to answer those questions you've been kind enough to send into us. And first up, we'd like to thank everyone for their questions. Now, remember, if you do have a question, the more detail you provide, the more likely your question will be answered. Also, remember not to send an essay in, not War and Peace. 1 or 2 short paragraphs will suffice. Remember, Janine and I have to read that. But first up, we do have a video, which are my favourite questions. And this one's from William. So take it away, William.
Dale and Janine, I wanted to thank you for the amazing work that you've done. I just got through Dale's first book, and I'm about halfway through his second book. I'm wanting to ask a question specifically about managing my cash position. I'm expecting a downturn in the U.S. economy here and a pullback in the stock market over the next months to come. And I'm wondering what kind of rules should I be thinking about cash accumulation? Should I be trimming some of my positions? And how should I be positioning myself for what I believe will be some buying opportunities here in the next months to come? Appreciate all you do. Thanks, guys.
Well done. I'm excited because that's our first international video
Yeah, I love the accent.
I know, it's good. He didn't tell us where he was from. He's actually in the US, but I didn't actually say where he's from. So,
is it
would
like
have been
Australia
nice.
where they have a different...
No, America's different than
sounding-
Australia. It's over the other side of some big water. There's a big lake you got to get across.
But is it like Queenslanders and Victorians sound different, and then on
they
one
do.
side of
Yeah.
the US and the other side of the US they sound different? Is that
Yeah,
is
well,
that how
Jim
it-
is from the south, so he's down from Atlanta in Georgia.
Yeah.
The other guys I deal with are in Texas.
Right.
And then and Manny that you've spoken to and I've spoken to, he's in New York, so he's got a real New York accent.
Okay.
Jim's got a southern accent, and the guys in Texas, well, they're out on their own again. So, geez, they've got big cowboy hats and guns, so I don't argue with them at all. But that's really what they're doing. But we need to answer his questions now. To me, when you're looking at how do you handle cash, some degrees, if you've got rules around your stocks, in my mind, is some of that sorts itself out anyway. And I think a lot of people think because we're talking about the market falling away into a low, September, October, whatever that is, or end of the third quarter, start of the fourth quarter, that all stocks will be falling in the market, and that's not necessarily the case. What you get is ebbs and flows in your portfolio, and I don't know, you can really add a lot of value onto that one, where you might have 10 positions now, but you might go down to 6 or 5 or 4 as the market falls away. But those 4 you keep will still be going up or holding really, really well, and the other 6 will start to fall away. So trimming positions, I think you meant not necessarily taking a little bit off each stock.
I think that's what he means.
Is that
I think that's what he means, taking a bit of profit.
Yeah, well, I wouldn't be doing that. So, and that's my thinking. But you might be selling some stocks, and that's my view of trimming that. So, what are you thinking about?
Look, I mean, I guess the first thing I thought about was the fact that you raised, which is we've been talking about the market pulling back, and they're looking at the market pulling back in the US. So he's trying to preempt what could happen. And so what you're talking about is you've already got a structure or strategy in mind. Really, that's what you're saying, isn't it?
Yeah.
So therefore you stick to it. You don't try to change that based on if you think that the market's going to pull back now, until you actually start to see some confirmation that it does. That's really what you're talking about, isn't it?
Yeah, I find some people, they just, Dale and Janine said the market's going to fall, so they just sell their portfolio. Not our students, but other people, they just go, we'll sell out of the market and sit back and wait. And then they might be in cash for 3 or 4 months, and then they go, when's the right time to buy?
Yep.
And that's not really about that. There's never really a time, the time that we're 100% in cash is generally short periods of time. They're not long periods of time. And what you find is ebbs and flows on your portfolio, that it grows and it shrinks over that period of time. But right now, as the market's falling away, it's a good time to restructure your portfolio based on some solid rules. And this is where I get a lot of emails from people saying, I've got all these stocks before I read your book, and how do I fix all that? Well, when the market's moving down, that's the time to start fixing your portfolio, because you can get rid of the dead wood that you might have bought by mistake, or there are any little positions. Sorry?
When rules trigger, or you're talking about small holdings that shouldn't have been in there anyway.
Yeah, small holdings that shouldn't be there, and other ones where the rules triggered, and you just tidy up your portfolio and then you take it from there. But really just look at the stocks you actually own.
Yep, really good question. Look, our first email question tonight is from Sumit. Hi guys, would you advise CommSec pocket investing? Now you know a little bit about this, don't you?
Nope,
they have about
about
7 ETFs to trade in their portfolios. Are these worth investing, or would you prefer Vanguard over Beta shares, and why? Thanks, Sumit. Now, I mean, these are ETFs, so we're talking about something that's, funds. Now, some of these could be index funds, or they could be specialty funds. I wouldn't necessarily pick one manager over the other. So Beta Shares is a good Australian one. So I always like to support Aussie companies who are doing something important over, say, and I'm not saying that American ones are not good, or there's other ones from other countries.
Just say
they
they're
could
not
be good. But I guess you've got to just compare what is it you're trying to do, first of all, rather than just taking advice necessarily from a website. It doesn't matter whether it's CommSec or what it is. You really have to understand what you're investing in and the risk around it, and have some rules to manage it. It doesn't matter whether it's an ETF or a stock, really. The same rules will apply there.
Well, I know with CommSec, this is one of the things we have a bit of an issue with CommSec, is they've got those portfolios that they suggest. Here's a portfolio, here's another one, here's one you can invest in. And there's this group of shares, and they just go buy all these shares in that through us. And I think that's the CRAP way of investing.
Yeah, so a model.
It's just a model, and it's not really looking at who you are and what's the best for you. And surely those stocks aren't a buy every single day of the week for months on end. They're just not.
But it doesn't really get people to think about how to structure their own portfolio and how to choose stocks.
No, and these ETFs are exactly the same thing. If there's 7 ETFs, why do you need 7 ETFs?
And maybe the demand was there. On the other side, I'll just play the devil's advocate here and say that maybe the demand was there. People want easy. You've said that yourself before.
Yeah, people like to turn their brain off and they go, I'll just buy that. And I agree with you. It doesn't matter who the ETF provider is. They're all good. They really are all good. You've got iShares, BetaShares, Vanguard, whatever they all are. They're all good.
But then what happens if things don't go the way that you're expecting? What happens if they've bought in towards the top? Then what?
Well, you're going to suffer the slings and arrows of the market movements, aren't you? And Janine and I are always going to be pushing people to buy direct shares because you're going to get a far better return and lower the costs on that. And I know they try and make it easy by having these apps and you just buy a couple of ETFs and they go great. Whereas stick to the top 10 stocks. If you don't have a lot of money, just stick to the top 10 stocks in the Australian market. Divide your money over 5 to 10 positions and then put it in there. If you don't have more than $10,000, let's say you've only got $3,000 or $5,000, just buy $1,000 on each stock. It's pretty simple. And CommBank is probably one of the stocks you'd probably buy from that point of view anyway. But anything else you want to add?
No, that's pretty good. Thank you.
Well, we can move on. It's my next. Oh, I'm sorry.
You're next.
Stay awake, Dale. The next email we have is from Kerry who says, hi, Dale. What about Janine?
It's okay.
I'm
happy with that.
She goes on and says, it's great to see an Aussie on YouTube for share market advice. I was wondering what sector or type of stock you would be more inclined to buy after market bottoms out next. Would you prefer tech, mining, finance, etc.? I was thinking of 5G and cloud technology. What sector do you think will do well? Thank you so much for your time and expertise.
Well, we just looked at some sectors, didn't we?
Yeah, we did look at the sector. Janine and I don't think like that. I think it's probably the first one I want to answer is Janine and I don't think like that is because it just depends on what's going on. And 5G may be some good opportunities in there, but it may be a year or two away, before it really starts to take off and it's worth investing in. So it's not about that. It's looking at what sectors when the market does come down. It's, how do I say it? You'll probably hear me say so often, it's trade on confirmation, not speculation. Just because we think the market's coming down doesn't mean it will. The market could keep going up for Christmas because we don't control the market. The only thing that Janine and I can control is when we buy and when we sell. That's it. That we can't control anything else. And so we need to make decisions based on what the market's actually doing, not what we might think it might be doing. So right now what we're looking at is the market starting to move up again, as of the strong move last Friday. It really took off. And our market was up nearly 2% last week. So it looks a little bit better, but that says we still are thinking it's going to go down into the third or fourth quarter. But when it does come down, then we'll look at the sectors and look at, okay, what has been hit hard, what hasn't been hit hard, what are the stocks within each one of those sectors, and look for the opportunities within all of those. We're not going to pick that sector now. Is there anything you want to add to that?
Yeah, that's really good. I mean, financials is one, I guess, that we are not keen on, especially not at the moment, because it could be reaching its cycle peak right now and coming into it. So there's one. We'd rather see that sector fall away first. So industrials I really would like to see turn and move in the right direction after a bit of a pullback. I'd stick with that area. I think he's got the right idea going into some of the technology areas. I think that's really wise to have some exposure there, but just to have a mixed exposure at this particular point in the market's the wisest thing to do. Now, if you were to go into a few financials, then it would be very selective. Be very selective about the stocks in that sector and pick the ones that actually rebounded well during the COVID environment, not because of a lot of speculation, but more because they're big quality stocks like Macquarie and companies like that.
Yeah, and it really depends on your outlook for your investing, isn't it? So is it short, medium and long term? And then that will then dictate the stocks that you're going to be looking at.
And the timing as well, because if it's more longer term, you can be forgiven for a little bit of volatility. But if you're looking more short to medium term, then you really need to time it much better into the market, especially when there's an opportunity here in the next, potentially 3 or 4 weeks.
Yeah, I think it's like to try and pick that right now is speculation.
Yeah,
I think that's
an opportunity for a peak potentially, and then
Okay, cool. All right. Thank you.
All right.
That's
Very
all
good.
I've got to say. You got to say?
Okay,
No.
the next question we have is from Robert. Hi, Dale. Mentioned on YouTube last night that you must own stock for 45 days before ex-dividend date to get a dividend. Did I hear that correctly? I thought as long as you hold stock before ex-dividend date that you would get the dividend, Robert. You do get the dividend, however, it's the franking credits that Dale was talking about. So the 45-day rule relates to that, and it came in because of all this
dividend stripping.
Strategy that dividend stripping. Exactly, you took the words right out of my mouth.
Okay. Isn't that a song? Okay.
Yeah, I don't. Who sung that?
Meatloaf.
Was that okay?
Famous? Bat Out of Hell. You
Oh,
took the words
jeez.
right. Okay, keep going.
Go for it. I think I remember that one.
You're too
All
young.
right. So there you go. We're looking at dividend stripping, and that was really what Dale was talking about. So that's a short and sweet one.
Yeah, because all we were talking
But
about
just
is
to clarify,
dividends.
there's
Yeah.
something on that, is that
Yeah.
they've actually got to be holding it. It's not, the 45 days is not just from the day they purchase. I think they've got to include 45 days plus the day they purchased,
yeah.
and plus a day after they sell it.
Yeah, it's got to
or the
be
day they
at
sell it.
risk. The money, your money's got to be in the share at risk
Yeah.
for that period of time before you get the franking credits.
That's
because,
right. And a lot of retirees, they'll be focused on that sort of thing, wouldn't they? Because, I mean, it's pretty important to get that right. I mean, look, I can remember in my early, I think it was years ago, I can't remember when that rule came in. Can you remember?
It's in the last 20 years. I think it's more like in the last 10 years or 15
someone
years.
asked me about it, and they said, oh, look, I've actually sold my shares, and it turned out that they'd actually sold them one day too early, and so they missed out on the franking, which is pretty tough, isn't it?
Yeah, I know before we sell a share, we always look at when the next dividend yield is and what's going on, because you can be beneficial to hold it just
Yeah,
for
but
an extra
sometimes
couple of
it's
days.
not worth holding it for the dividend. If the stock's going to pull back, we're expecting a low to come in and it's closing below its trend line, or it's given an exit rule, sometimes the stocks will fall much more than the dividend, so it's really a judgment about where we think
and
the
I know
stocks.
even before they brought the 45-day rule, and we weren't even really keen on the dividend stripping type strategy.
Yeah, because if you're only getting about 4 to 5%, so you get 2 or 2.5% twice a year. If the stock pulls back 15% in one go, what's the point in waiting for that dividend? It might keep falling. I know that with property stocks, there's a lot of people that wait for the dividends on those property stocks because the dividend can be quite good. But the challenge then is if the stock pulls back, like someone look at the property stocks lately. You know, there's only a couple of really, good stocks like GMG is still going up, but a lot of the property stocks have been really struggling.
Oh, well, they're correct, yeah, very, very much so. But, I mean, to me, the 45-day rule is really about, it's just stopping the dividend stripping. But, again, you shouldn't be investing for dividends. You should be always, like we talked about last week, it's always about total return to me. It's not about, I get 4% from a dividend yield. It's what is your total return of your portfolio, not
Yeah, that's
just
important.
what is it on CommBank or what is it on BHP, how much did I make? And I think a lot of investors and people talk about, I made this much on this stock. Well, that's great, but what did you make over your total portfolio? Did you make 5%, 10% or 50% on your total portfolio? And what was that whole total return?
And what is the total portfolio?
And what is the total
Because
portfolio?
what people often do is they'll look at what's happening with the stocks that they've traded, not the total amount of cash that they've allocated, which is technically the portfolio.
Correct.
Yeah, so they're only looking at the performance on the shares, the money they've invested.
Yeah, no, like if you had 100,000 and you only had 50,000 in shares for the last 6 months, people look at the performance on the 50,000 in the shares, not the total 100,000. So they're not including the cash component.
Correct.
So yeah, but let's keep moving on. Remember, everybody, just hit that subscribe button now if you like our show, and also like the video. There's a little big hand there. Click on it, and remember to share the video of tonight's show on your
Did
social
you point in the
media.
right direction then?
Sorry.
Was it down? Or?
There's a little thumbs up that you got to click. Don't ask Janine to get it onto her social media, but share it on your social media so everybody can find our show and everybody can help the show grow. So, but I'll shut up now. It's your turn.
Okay.
Anyway,
your turn.
that's my turn again. So now's the time we get
I'll
into
set
the
you up
topic for tonight's show, which is Australian superannuation. Is this the best way to save for retirement?
Now, we all want to retire comfortably, but surprisingly many Australians are unaware whether they will be able to achieve this. That's really daunting, isn't it? So how much super is enough?
Never enough.
Superannuation is supposed to be there to fund your retirement, but is it really a good investment strategy? And is the best way to save for retirement through super? Do you want to rely on a managed super fund or maybe a self-managed super fund to save for retirement? And what are the risks and benefits of both? Tonight, we thought we'd get the boxing gloves out. See, I've got my Dukes up.
Hey, I ain't scared.
Is Dukes still a word? It's an old word, isn't it?
I'm ready for your boxing. I've got my mouth guard and I've got my hard hat.
Actually, your wife's pretty tough. She gave me a few pointers before I came on the show.
Yeah, take the diamond rings off. Don't have them on. Jeez, don't do that one. Yeah.
That's dangerous, isn't it?
So what are we doing?
We're actually going to go, we're supposed to go head to head and debate this thing, so I think people have been expecting us to do that. But some of the things we actually agree on, which is hard, isn't it? How do you debate that?
Well, how much? First, the question is how much? We all have super. It's mandatory, so we can't get out of it. If you work, you're going to get super. So we can talk a bit about that.
Yeah.
But I think the first thing is well, how much is enough?
How much do you need for a comfortable retirement? That's probably more important, isn't
But
it?
what is a comfortable retirement? I know when I see statistics, you say, oh, well, you need this much money to have a comfortable retirement. But when you go in and look at the actual definition of a comfortable retirement is, I'm starving. Like comfortable,
you eat a lot.
Comfortable means you own your own home outright. And that you can put some food on the table and pay your bills and maybe have one small holiday a year within Australia. And I think that's about it. Maybe replace your car every 10 years or something. It's not a lot
you've
of
blown
money.
the budget already.
I blow the budget in the first month, I reckon.
And you told me that your wife would blow the budget, the holiday budget.
Shh, no, she won't. No. But it is, but how much is enough? So what are they saying is enough for people?
Okay, I mean, look, the statistics are interesting, aren't they? Because when we're talking about your super savings, it's there's a number. I think it's something like $50,000 or $60,000 that's supposed to be for a couple that they need that per annum.
$50,000 for two people in retirement.
In retirement,
and that assumes they own their own home.
It wasn't completely clear. I think it's that they own their own home. They're not paying rent.
Yep. So and is that assuming it's coming from, and if,
but it's assuming also that they could be getting some of the pension as well. So, look, I don't like those sort of numbers. You've got to have two lots of numbers. So, what are the numbers that that we would expect someone who is not receiving a pension or a part pension, would have? That's really the question, isn't it? So it's going to be around that. It's probably going to be around that 60,000 anyway.
Yeah, it's going to be around the 60,000. Now, for you, if at home, if you want to understand what's good for you or how much you need, go to ASIC's website. So the ASIC's Money Smart website. So asic.gov.au. Go to their Money Smart website. They do have a lot of calculators on there. I know we showed one the other week on compound interest calculator, but they do have one on helping you understand how much you need for your super. So it's a really good place to go. Also, the Association of Superannuation Funds, AFSA, estimates that the lump sum needed at retirement to support a comfortable lifestyle, as Janine said, $640,000.
Well, I didn't mention that one yet.
You didn't
I was just talking about the per annum figure that you'd need. But yeah, you're right. $640,000 is what they're saying.
Yep.
And the $545,000 for a single. But it's interesting. There's not much difference really. It's $100,000 difference.
$100,000 difference. Yeah. Well,
but I guess it's the power, isn't it? Your energy consumption and all of those things that are a fixed cost.
Yeah, but I mean, the average male is retiring on roughly $250,000, $250,000. The average female is retiring on roughly $160,000.
In super.
In super. So if we add those two together, that's what, 300 and 410.
I think it'd be
less. Not even close to the $500,000 a single person needs.
If the market hits the funds industry and then wipes out a percentage, I mean, okay, the market's rebounded now, but if the market were to continue to fall, it's going to wipe that figure out.
Well, correct.
That's the risk with super, isn't it?
Yeah, I mean, I've been arguing for years that superannuation is SHIT. It really doesn't help people retire. So
you're cheating here. So you're avoiding saying a swear word.
I know, I did it.
By spelling it out.
I could say tish, that's backwards.
Yeah. I've been told by the director.
I don't have any more money. I better go and raid my piggy bank.
Did that hurt everybody's ears? Sorry about that.
Probably did. Yeah. But the thing is we've had compulsory superannuation for how long? Since the 80s.
Oh, look, it came in 1992, the super guarantee scheme.
It came in earlier than that.
Yeah, but super's been in for longer.
Sorry.
Yeah, but not everybody got it. I think public servants got it.
Yeah, I was getting it in
years
86, 87.
And there were companies who were providing it for their staff, so it depended on the industry and the company, I guess.
So super's been around for over 30 years.
Yeah.
Yep.
Well, yeah. And so this is the interesting thing, isn't it? Super's been around for that long, and yet we're still trying to work it out. And the problem we have is that there are a lot of people who actually go, who fall under the radar, so don't get picked up. That's really part of the issue, isn't it? So it's not
my argument.
It's not a good investment for everybody at this point.
No, because it's to me it's enforced savings, because if the government, what part I like about it is it makes people save, because if it wasn't there, people wouldn't save.
Well, that's where we really agree, isn't it?
That's where we agree, but as a good investment vehicle, has tax advantages, but the rest of
Great
it's...
tax advantages.
But the rest of it's... it's not good investment in terms of you don't make a lot of returns out of it, especially managed and everything else. So to me, it's really about where we're investing in, and do you do it yourself, or you get a managed superannuation, because you've got to have it. It's a necessary evil, isn't it?
Yeah.
But the other thing I'd like to probably add to it is a pension is not a retirement strategy.
Yeah.
And this is where people put a government pension as their retirement strategy. I'd rather retire on a self-funded retiree every single day, because you can have more money and you have more flexibility and freedom. Because I don't know about you, but 44,000 per annum, while a couple's probably 62,000, for a modest lifestyle. It's about 28,000 for a single, 41,000.
That's a modest lifestyle.
Modest lifestyle. And so that's
28,000 for an individual.
That's borderline, I'm starving to death at that kind of return. So is that really enough? And I don't think so. But let's move on, and we'll go on to some more points, and we'll get to there. But as I said, you can go onto the Money Smart website and estimate how much super you're going to have, or you will
There's
need
some really
into
good calculators
retirement.
there.
And there's some great calculators there. I'm always on the Money Smart website.
It's really important. I speak to young people about this as well, to actually project how their savings are going and look at how those calculators can help. So if there are parents out there, it's actually the best place to put your child in front of a computer and get them to put some calculators in there, get them to put their savings in and the rate at which they're saving, and see how that goes over time. But back to the compulsory super, we were talking before about that it came about in 1992, so it hasn't been around all that long. No. And actually it was a Labor government, I think it was Hawke and Keating, wasn't it, that bought that out. So we've actually got, regardless of whether you love them or you hate them, you've got them to thank for that. It's been a really great thing, I think, for Australians. And the challenge too is that, it's getting at the level up high enough. So we started off at only around 3%. Yeah. It got to 9% by 2002. We haven't really grown it from there. It's only on 9.5% at the moment.
And we need to be doing more like closer to 20% for people to retire on that comfortable lifestyle that people want. And people are going, wow, 20%.
But that's taking money, right, from people's pay packet that could otherwise be used to pay down, non-deductible debt. And this is one of the... Yeah, but this is one of the things that you've talked about before, that people would be better off not contributing extra to super and paying down their loan.
Correct, but people, even if you... Thing is people run out of money before they run out of week. This happens. And the statistics in Australia are like 1 in 2...
Can you say that again? Because it sounded like if you run out of money, you run out of week.
You run out of money before you run out of week.
Week, okay.
Yeah, week, not week T or something, but weeks, like days in a week. So, and people do that, and that's where these buy now, pay later places are really taken off, because people are spending next week's pay before they even get it, because they've already run out of money. Yeah. And we're talking about there's a big chunk of Australians, I think it's about 2/3 of Australians can't live for more than about 6 or 8 weeks without an income coming in, which is basically means we're broke.
Yeah, so how do we help those people?
And that's really why superannuation, the compulsory superannuation, is here to make people save. It's enforced savings, so at least they're going to have something in retirement.
Yeah, I think it's great. From the point of view of building the nest egg with a tax-friendly environment, it's really great.
But is it really a good investment?
Well, look, it depends where you put your money, doesn't it? I mean, these days it's really a flexible environment, more so than what it was in the past. I can remember probably a decade ago talking to people saying, I can switch my investment from one fund to another, or in different types of investments. So the point that they've actually made it more flexible, I think, is great. But then the people who are making those decisions and the switching, do they really know what they're doing?
No. Because what I found is when I've looked at that is generally people switch at the wrong time. Because they, and this is the research I did for my first book, How to Beat the Managed Funds by 20%. The best performing fund in any one year was never in the top 5 the next year. It was always down the bottom. And what happens is people see, my super didn't perform that well this year. That one performed really well. And then you see all the ads come to this super package because we did this last year.
And they can see that
and everybody switches, and then the only way from the top is to down, and the only way from the bottom ones is to go up. So stay with the bottom ones, or find the bottom one, because they'll be moving up and you'll get a better return with that. But as I said, the only thing I like about super is the tax efficiency of it. That 15% tax on it, and so whilst the scheme has helped a lot of Australians, I believe it's a great thing for people to get into.
Yeah, and particularly for women. It's really been important for women and changing futures of women, but it doesn't really go far enough to help women, and that's why the argument about whether there should be a greater level of contribution to super is there, because if a lot of women who are disadvantaged, if you like, wouldn't have that opportunity to have that saving sitting there when they retire. So look, I guess if you look at some statistics, there's a women in super website, 46% of the workforce, are women. 44% of women still rely on their partner's income, which is a really big statistic. And women take on an average of 5 years out of the workforce to care for the children. So, you're doing something that for a really good reason, but at the same time, you're disadvantaged in terms of your income and the superannuation savings at the same time. No. So there needs to be that 5-year period they're talking about needs to be factored in. And you had some ideas, didn't you?
Yeah, well, I think, if a lady's working and they want to have a baby, they should be given the choice to be able to stay home with the child for that first 1 to 5 years, however long they choose, and not be disadvantaged. I would rather pay for ladies to be able to just finish work and spend 1 to 5 years with their children and get paid.
And you want them to do our course at the same time, though, wouldn't you?
Well, they could do our course, but to me the benefit is twofold. One is you get better children because mum's at home and they get a better upbringing, they get more love, the whole bit, they get better balanced children.
Yep.
But then the lady's not disadvantaged as well, because 50% of marriages end up in splits. We know that in divorces. So to me, it's like, why shouldn't we be supporting these ladies who want to do that rather than making them struggle going back in to do part-time work and all the other stuff? So, I think we need to look after the society, don't we? And, to me, the argument is, you get extra money because they're thinking about raising the superannuation guarantee, taking it out of people's pockets, then they could be paying off their debt. They're not going to do that. We've shown
you can look at it this way. You're either going to have to fund those people once they get to retirement anyway.
Yeah.
So why not actually give them it's the, what do you call it? It's that
robbing Peter to pay Paul. No?
No, it's actually the dignity. Like, allow people to have that and the opportunity to have the financial position going towards retirement, so they don't have to stress about it all before they get there.
So whilst financially it's going to be better to pay your money into the mortgage, if you pay extra money into that mortgage, it'll be much better financially for you. In the end of the day, people, if they've got spare cash, they're spare equity, they're going to use it. They're going to keep borrowing money. That's what they're going to do unless they're forced to save. That's really what they're going to do. So to me, is super a good investment.
Look, in some cases, paying the money into the mortgage is good, but super will always be one of the best investments I think that people can make.
Now we need to move on too, because we've got a couple of things. We're going to talk about self-managed versus managed as well. Now you've got some stuff from the Grattan Institute, yeah?
Yeah. So look, they're actually arguing that the vast majority of Australians will have more than enough for retirement. Now,
I reckon that's BS.
Well, they said they'll have about 91% of the pre-retirement income will come from their super. Think about it this way: if the super, if your retirement age is getting older, and you're only like the average age that people live to is in the 80s, so you're talking about a 70, maybe 15 years for retirement. There's only 15 years in there. So I actually spoke to someone, this was going back maybe 10 years ago, 8 years ago, and she was actually building up her superannuation nest egg and her personal savings as well, and working really hard and doing all of this work. And then she hadn't actually looked at things from keeping the end in mind. So she hadn't looked at where she would be based on what she was doing now, building her wealth and all of that, where she would be in her retirement. So she actually didn't know when to stop. So that was a really important thing for her to actually go and use those calculators, have a look and see how much do you actually need for retirement from where you are currently now before you can do that. And I think that was a really important shift for her.
Okay, so let's move on, and we need to talk a bit about self-managed super and stuff like that. But
look, based on the Grattan Institute, as we're moving on, they were just talking about scrapping the potential to have that 12% contribution because of that reason. So
I'm not in favour of scrapping. I'm in favour of putting it up, because the more people don't have it in their bank account, the less they're inclined to spend it on stuff they don't necessarily need.
Yeah, well, that's a good point.
And again, it's like...
Because you can always redraw from a mortgage, can't you?
Correct, you can always. But anyway, we all have our opinion about whether the super really is a good investment.
Look, we haven't really had a big blue, have we?
No, not yet. I'm working up to it. And we believe there are a lot of issues, and many of you should have asked whether you use a managed fund or a self-managed super fund, and that's what people are asking. Is now a managed fund is easier. They're just more flexible. It's as simple as that is. But a self-managed super fund, there's a lot of regulations and legislation to understand so that you're compliant. But it's not impossible. And I know a lot of people talk about superannuation. They go, I want more control. I want to lose it or make it myself, and I want to be responsible. And I hear things like, well, if I'm going to lose my money, I might as well be responsible for that than let a managed fund handle my super. So I'll just do that.
But a lot of people don't want the responsibility of keeping up with all the documentation and the legislation that they have to do. Yeah, well, the industry make it sound like it's hard. Why do they do that?
I saw one post on one article on the industry saying it's too expensive to manage your self-managed super fund. Your fees are going to be $10,000. And I said, really? My fees last year were $1,500. I went, what planet are you on?
But it depends on your accountant. And it depends on the type of investments that you have and how complex those investments are.
There are a lot of new services out there. So managing a self-managed super fund is not hard. It's super easy if you know how. You know, we have people who've read my book are managing their own self-managed super fund, because there's a difference between the compliance and the investing side, but you need to know both. The compliance, you can hire people to help you with that.
Yeah, because the self-managed super fund, there are all sorts of regulations, like the regulators suggesting that you need around $250,000 to invest because of the fees involved. So you've got the financial accounts to be done at the end of the year, and you've got the auditing to be done.
But I reckon a lot of that's a bit shifty too, because the big end of town wanted to keep you in managed funds, and so if the average male's retiring on $250,000 in their superannuation. So why do they set it at $250,000?
No, look, I think they have to protect people because people do silly things. Look at the GFC. People made dumb mistakes by putting, all their funds into one or two stocks because they thought they were going to win. And I think with superannuation, particularly self-managed super, there's a risk that people could do the wrong thing. So they put some of the infrastructure and the legislation and everything there just to protect people.
But the bastards won't stop playing with it.
But you can actually set up a self-managed super fund with less than that. Like you said, that there's no hard and fast rule particularly, but there are certain people that wouldn't necessarily set up a self-managed super fund.
The government's never going to stop playing with it.
They'll close the door.
The big end of town are still going to want to steal your money.
Well, they'll close the door on people if they come up and say, I want to set up a self-managed super fund with $50,000. So, it's just not going to happen.
No, I'm retiring without super. That's my play money. But let's move on anyway.
Okay, let's get into some more emails, shall we? But before we do, remember to hit that subscribe button now. Now, remember, it's down here, Dale. Do you remember that?
It's down, I don't know. Thumbs up.
I bet the producer or the director will probably put it up there now and I'm going to look silly. Give a big thumbs up and click the like button. So the more people that click the like button, you'll be helping us, because I'm reading out this part of the script this week.
Okay, but we now have a question from Andy who says, hi Janine, I'd be interested in your views on DXN. I recently bought in at 2.5 cents, thinking it's bottomed and turned around. Am I too early to think this? I purposely didn't ask Dale because I didn't want a scolding for buying a small, relatively illiquid stock, but I'm bracing myself for these comments. Cheers and keep up the good work, Andy. Brave man.
Why is there this perception that I'm going to be softer on everybody?
I know, but he already knows he's done the wrong thing because he's telling me I'm going to tell him off. So he already knows he's done the wrong thing.
Okay.
It's like the child walking in with their biting their lip going, Mum, but...
You've done that before, haven't you? Otherwise you couldn't tell that story.
You can answer him.
All right then.
My silence will be deafening.
Yep. Okay, so looking at DXN Limited, it has been in a long-term decline, so downtrend. And according to the monthly chart, it hasn't actually confirmed that it's going up yet. So that's a real challenge here. However, when you look at the shorter term perspective, it is looking like it's starting to move higher. Now, the concern I have is the volatility and the liquidity of this type of share. Of course, he's going to know that's a big issue and it's a much higher risk proposition. But let's just have a look at what that actually means. So again, you've always got this little PRP tool up here, which is a price range percentage tool, just to help you guys out there to understand the lingo.
I gave you the mouse to use tonight and you're still using the trackpad.
I know, I'm just so used to it. I like the feel of the keyboard. Okay, 167% rise. Okay, so it is a risky thing, because if a stock can rise that fast, it can actually fall twice as far and twice as fast. So therefore, be very cautious with these types of shares. The other concerning thing looking at the chart is that there is a gap on the weekly chart. Now, for these types of shares, they're filling gaps. So you see here that's traded up and filled the gap. The real risk now is that it could come back and Dale's going, oh, careful.
Can I say something?
Yes, you can. Go for it.
Next week, our show is going to be on micro caps and what you need to know how to do this sort of stuff.
Right.
So
isn't that exciting?
There you go. I've already started constructing.
Are you now going to the dark side? Is that
I'm going. I'm looking at a couple of
You're
micro.
taking a step over.
There's a couple of micro caps I look at, and I have been looking at. So there's some exciting stuff. Any more you got to say on this one before I?
Only that there is a real risk here that the stock could fall below this low here. Now, if it falls below the low of, is it 2.2 cents?
Something like that.
Week ending the 7th of August.
I didn't even put my glasses on for this one.
No. Then there's a real risk that it could come back and fill that gap there. So that's a problem. And the challenge is with these stocks, they can be manipulated really easily.
All the time. All right, next question.
So DXN, next question is from Nick. Hello, Dale and Janine. He said mentioned both of us there. You'll be happy now.
Yeah.
Dale, have just finished your book. Fantastic. Well done. I'm now in the process of drawing up my trading plan. Wow, this is awesome. After the fact, as I am already holding some stocks, okay, but at least it's better late than not at all. Would appreciate your thoughts on Woodside. I'm in at 21.60 with a stop loss set at 19.44, a 10% stop. My thoughts are hold for now, and hopefully it will improve in the COVID situation. Thanks in advance, Nick. So there we go. Thanks in advance, you said.
Let's go to Woodside.
Yeah, looking at Woodside, it's actually been pulling back. So, okay, he's got a stop down here.
So he's in a slight loss at the moment.
Yeah, and it is heading back towards his... you don't let me use the crosshair, do you? Because I really love that tool.
No, you can use it. You just don't leave it on all the time. So I'm not that cross.
Yeah, you're not that cross. Okay, 1944 is just below the recent low.
So that's his exit strategy.
Yeah, so it's really getting close now. So Nick, you really want to see this stock start moving up, and it may do that now. We may see it move up above $21 in the short term. So a close at the end of this week, a close high on the bar for the weekly bar would be a really good sign that it's more likely to do that than fall away. But I'm just really excited that you've actually written your trading plan and documented this, even if it's after the fact, because it's showing that you've got some discipline that you're bringing into your trading, which is great.
Yeah, I mean, obviously this week it's a little bit of indecisive at the moment. It's really just floating, which means this is not really wanting to fall away at the moment, is it, really?
It's not wanting to fall away, and it looks like it's being range bound, really, isn't it?
Yeah, so hang on to it and stick to your stop loss. I think that's really what we're looking at it. Yeah. The next email we've got is from Chris. He says, hi, Dale and Janine. The meltdown back in March triggered my interest in the stock market, as I believed it was the perfect time to educate myself to possibly find some excellent investing opportunity. I would agree. I bought both of your books, started the trading mentor course, and have since stepped up to the diploma. Oh, fantastic. Loving the content and studying the charts. I'm a bit obsessed. Yeah, so are we. This should get my email on the show. He says, ha. So Janine's picked all the emails. I hadn't read them. So while conducting top-down analysis, I came across Meridian Energy, MEZ. The fundamentals are strong. It has solid market cap of 12 billion plus and moves in long, steady trends on the charts. My question is, why are the volumes so low? What do you think of the stock, and will it have liquidity issues? Keep up the great work, Chris. That's interesting. I've never seen this stock.
Now, first of all, I'd like to take a peg out of Nick's cap, the previous question.
Take a peg out.
Say, yeah, because he's an example, because he's written a trading plan. So I wonder if Chris has done the same thing. Chris, I'm putting that question back to you. I hope that you've actually written your trading plan. There we go. That's as tough as it gets. No, Meridian Energy Limited, MEZ. So you can see there on the monthly chart, it's just got that toppy look about it. So, we've seen these three tops, these three peaks occur on the stock, and it's really poised right now to take a direction either way. If it trades above approximately $4.65 or $4.70, it's more likely to go up. But if we see it push back below the recent low down here of, what's the low there, $4.33, then it's more likely to continue to fall. So it's really that simple when you're looking at
volumes, he's mentioned it has low volumes. Could there be a liquidity issue?
Yeah.
I would need to do some research, but one answer for that would be some stocks are very tightly held, and I know Sol Patterson was one of those. It's been held by the large family interest. So you'd need to look at the shareholders of this. You might find there's some shareholders that own the big chunk of it, and if they're not selling or they're not turning over their stock, then that's possibly why. And this was the case with the ASX back when it floated back in the 90s. When it floated, members of the Australian Securities Stock Exchange at the time got shares. They got all the same amount of shares, if you remember. So you had all these stockbrokers had all the shares in the ASX, and stockbrokers generally hold. And so for quite a long time, there was very few shares traded on the ASX at the time. So the share price just kept going up and up and up because there was very little liquidity. But now there's a lot of liquidity on it because a lot of the stockbrokers at that stage when they got the shares, they were fairly old, and a lot of them have died off, and obviously...
But there's a lot more shorting that goes on as well now.
Yeah, so we're talking about so that was, early on it was illiquid, even though it was a very highly capped stock. It was a liquid. And this may be the case with it. I haven't had a look at it, but go and have a look at its share registry. Go on to its website and look at who owns all the shares and the players, and they tell you.
I've got the volume up there.
Yeah, it's not a lot.
So you can see it's not a lot.
156.
And, it's a $4 stock. So you multiply that out. It's not a big value per week being traded.
Yeah. So, but just be careful with it. But anyway, let's move on.
All right. The next question we have is from Jim or James. Hi, Dale and Janine. Could you please have a look at CBA?
Yes.
Great stock. I'm thinking that if it closes this week above the July high, it would be a good opportunity to buy. However, I am wary of the market risk at the moment. Cheers, Jim. Thanks very much for your question, Jim. Let's have a look at CBA. And you wanted to also have a look at some of the other banks as well, didn't you?
I think while we're looking at CBA, let's look at a few of the banks.
Yeah, I mean, look, do you want to try and overlay them over the top of it, or do you want to look at them separately?
You're in charge of the mouse.
Yeah.
I gave it to you, but you're not using it. But CBA,
look, let me see if I can.
We do like, out of the big four banks, I think CBA is our preferred bank. I think that's what we probably want to say to you is our preferred bank. It has been going up nicely. NAB and probably ANZ are the two least preferred out of the big four, with Westpac coming in under under CBA, and Macquarie, obviously that's the pick of the bunch, and Macquarie's done so blisteringly well since from the GFC low up. It took off like a rocket. It got hit a bit with the COVID, and it's been doing really well since, obviously. But of the big four at the moment, CommBank is the preference there. Now Janine's overlaying, and you'll see on the chart in a second, you'll see her overlaying, or she's doing that now.
Just to make it more confusing, I'm
just overlaying all four banks onto the one stock, and she'll explain it in a second. You'll make sense of your chook scratching soon, won't you?
Well, look, I thought chook scratching. That's fabulous. I thought I didn't know you were a country boy.
I am. I'm way back. I'm born in Geelong, remember?
All right. So looking at this one, you can see that the red chart is not one of the four banks. It's actually Macquarie. So there's a comparison between what Macquarie has done and what
full screen so they can see it.
Yeah, that's a good
Some people
idea.
like me needing glasses.
Okay. And you can see what Macquarie's done versus what the Commonwealth Bank's done. So Commonwealth Bank's still at risk of pulling back at this point here, although it's actually coming back up to a zone that it really likes to trade within, which is around about that $74, $76 mark. Historically, it's like that. So we may see it just hover around in that zone for a little while now that it's pushed up to that level. But the other banks, which I'll hide Macquarie now just because I thought that was fun to have that on there. We'll just hide that there. And we can see that I've put Westpac and NAB there just as a point of comparison. I haven't put ANZ on there at the moment. But you can see how they've actually gone down in this massive decline that we've seen unfolding. It looking like could be coming off a bottom. But the challenge with that is there's always a risk that they could keep going down, or they could come back and check that bottom. So in the short term, there's a risk in the financial sector.
If you're a long-term buy and hold, though.
If you're a long-term buy and holder, and you bought in, you would just be hanging on to them at the moment.
Yeah, but I mean, it's how low are they going to go?
Yeah.
From a long term.
Look, Westpac and NAB, you wouldn't think they're going to go too much lower than where they are. I mean, when I say too much, it could be still 20 or 30% from where they are, and that's the real risk. To see your capital get dwindled away and then be waiting even longer for that recovery to happen.
Yeah. So if you've got a 10-year outlook, and you've got money to put into, whether it's a self-managed super fund or whether it's your own portfolio,
I'd still be waiting for a confirmation though.
Yeah, cool. But again, it's about, whilst we think the market's going to fall away over the next couple of months, it could be a nice time to pick up some banks at a really cheap price if you've got a long-term outlook. If you've got a short-term outlook, different story again. But
look, I think I'd still be waiting for some decent rules. If it was a long-term outlook, then you don't mind waiting a bit on the monthly chart, because if there's going to be a big run, say the likes of this move up from 2011 onwards, and remember, everybody thought markets were going to capitulate further back then.
They were, yeah.
Right, and yet they turned around and recovered, and that happens over and over in the history of the stock market. And look what occurred. But you wouldn't mind giving away that move off the bottom. Let's have a look at what happened just quickly off that low there in 2011. I'll expand it up in a minute.
Yeah.
I just realised that I'll
What have you done?
have a challenge here if I leave the overlays on, so I've got to just hide those for you for a minute. So once I've hidden that, I can then show you what that move was. Now, let's have a look. So it's off the bottom, it was about, 20% roughly to this zone in here. So it had actually recovered 20%. So you're not concerned about giving away a move off the bottom to get into one of these trends, really.
And that's the critical point, because I know last week we talked a little bit about people penny pinching, trying to sort of get in at a low price. And we have people saying, I had somebody who sent me an email this week and said, look, this triggered my buy rules, and I had my entry set at this price, but their price of entry was the same price as it closed on Friday.
Right.
But they didn't allow it any tolerance to open up a few cents higher, whatever else. And so and whilst to me that's a bit penny pinching, you should always give it a bit of a tolerance there, maybe a few cents.
So you're saying they didn't get in because...
No, they didn't get in because it gapped up and it didn't get in, and it didn't trade to their buy price because their limit was the sell price, the closing price on the Friday.
That's unfortunate, isn't it?
And it is unfortunate because it actually went up quite well the next couple of days, so it did very, very well. And this is what people do. They try and penny pinch and go, I'll try and get this low price, but I would rather see a stock move up and up and up and up, maybe 10, 20, 30, 40% to know it's rising rather than guess at it, because if a stock's already in an uptrend, then the probability is it will stay in that uptrend until it's not anymore. And so if a stock's in a downtrend, the probability is it will stay in that downtrend till it's not anymore. But at what point is that? And most people can't get that, but they guess at it and they hold on to a share, they buy it, they hold it down even further because they're trying to penny pinch.
Look, Commonwealth could be up now. It could, and it could continue to go up over the next couple of years. However, it hasn't had a retest of the recent low yet.
So we've got our last question for tonight, and it's a biggie, and you've given that one to me. I know it's a biggie. It's from Ross, I think, who says, "Hi, Dale and Janine. Thanks for your weekly updates and live show. They are both very informative, and I'm a medium to long-term active investor designing a growth portfolio consisting predominantly ASX 50 stocks." He's very good, isn't he? With a percentage extending out to the 100. Fantastic. A stock I'm watching as a potential entry into is Woodside, with the forecasted EPS growth over the next 2 years. However, the uncertainty surrounding oil prices remains a concern. Now, Woodside has been in a long-term downtrend since its all-time high back in May 2008. However, it historically goes on rises of 20 to 50% when it turns upwards. I've identified 3 successive down bars in July, August and September, and drawn a downtrend line from June 2019 that crosses August, September and October, and he did attach a chart. He says, "Am I correct in my analysis that should August close above 21.13 mark, that this would trigger a buy signal? You are both experts and I'm the beginner, so I'm expecting harsh feedback. I don't take it as offensive. It's part of learning and acquiring more knowledge to become a better trader. Thanks, Ross." I think he meant me about the harsh feedback. Because can I say something about his chart?
You saw it, but just go easy on him.
It's not a trend line. It's not even a trend line's backside, basically. That's how bad it is.
Okay.
But
he had a go, and I admire that.
He did have a go, so I think that's pretty good, but it's not a trend line.
Okay, so you're not even going to show
before you go on,
Yeah.
the answer to his question, no is the answer. If it does do what he said it to do in August,
right,
that's not the trigger to buy.
Yeah, okay.
That's the pertinent point, yep.
Okay.
So now you can talk about the stock.
So if we're going to talk about Woodside, we've already talked about it, but if I talk about it in relation to trend lines, and you don't want me to draw them, do you?
No, you don't draw them.
But if I go across the top here, and we're basically looking at the trend down, right? And we're seeing how far it is away from the trend. It's got a long way to go to get back to the angle of that trend, is really the point on the monthly chart. On the weekly chart, it's much shorter, but there's no trend line down that decline is what you were talking about.
Yeah, there's no trend line down there.
Yeah. But there's something interesting. I just want to digress and show, what was the gentleman's name again?
Ross.
What I wanted to show Ross
It's only 4 letters, it's not hard.
No, what I wanted to show Ross was that he may not be aware of how well, he was talking about the oil price, but how well Woodside does track the oil price overall. In terms of the overall pattern, so when we talk about patterns on stocks, this is actually a long-term pattern that the stock has formed. And it's just fascinating, isn't it? There'll be times when the oil price will digress and change direction slightly differently to the stock itself. But that can depend on how the company's got themselves set up in relation to the oil price and how they're hedging themselves as well, and the activities that they're undertaking. And but looking at it at the moment, it's actually following it again.
It is following it, but oil prices, what do you think oil prices are going to do?
Well, I've done a podcast on oil.
Oh, okay, so you're not going to tell anybody. You
So
have
it's a
to
top
listen.
secret
They have to listen to the podcast. Okay, so she's not going to tell you that. Right now, it is looking like it's setting up. So if you look at the chart, but I wouldn't be getting in around that 21. I'd be looking more over the 26 mark. I want to see it move up a bit stronger before I would get into Woodside. But keep watching it, and look, I thought your analysis and everything else and how you structured your email was brilliant. It really was brilliant. It shows you thinking about it. So pat yourself on the back, Ross. I think it was really good. You just don't know. Your trend line's not that great. We need to work on that one. But we'll get to that anyway. As a beginner, you gave it a shot. So that's the main thing. But
Now, it's the end of tonight's show.
okay, is it?
Yeah, that's it, unfortunately. And I hope
sad.
that you've enjoyed it, and thank you for participating. If you have a topic that you would like us to discuss, send in your ideas and we'll look at your requests for upcoming shows.
Okay, now remember to hit that subscribe button and like the video because it makes Janine happy. Also remember to share the video of tonight's show on your social media with your friends and colleagues so the show can grow and we can help more people. Now also remember to put this show into your calendar as we'll be back here, right here, every Tuesday night live, 7 to 8 p.m.
As always, we are happy to receive your 30-second video questions, so send them to info@wealthwithin.com.au and just type Wealth Within Live in the subject line. You must do this before 3 p.m. Tuesdays to get in that night's show. Please don't make me get on my skateboard and pedal fast.
Well, that really does bring us to the end of the show, and again, we really hope everyone has enjoyed it as much as we have. Always, thanks for joining us, and we hope to see you again next week. But for now, goodbye.
Good luck and good trading.
Stay safe, everybody.
Bye for now.